It turns out that layoffs, unemployment, and recession have predictive qualities amongst each other, but in a very contrarian sense. Let's jump into that right now.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Welcome, as always, to the Trending Report. Today, we're going to be reviewing data as it ended last Friday, which was March 24th. And we're also going to be talking about the relationship between layoffs, unemployment, and recession. There is some interesting connectivity there. There's some interesting predictable qualities. However, it's predictable qualities in a way that you probably wouldn't necessarily expect. In fact, they almost feel a bit contradictory. That's what makes them interesting, and we're going to jump into that right now. So here we are looking at the fact that since October of 2022 through basically last month of March, or this past month of March, we have seen about 500,000 jobs disappear in the marketplace due to layoffs and so on. Now, the biggest of those has been in the technology sector. The next biggest has been in the consumer discretionary sector. And then it works its way around the horn here on this particular graphic. So tech, we've seen a lot of announcement in the news lately about these layoffs. Consumer discretionary kind of makes sense, going all the way back to the pandemic. It's been a really tough time for that sector, not being able to get service workers, restaurants closing, storefronts closing. A lot of that consumer discretionary type service business has lost a lot of jobs. So those are the two really big bubbles we see here. And then after that, we've got financials, industrials, and communications, which are all kind of in that same neighborhood, numerically speaking, and then we round out the rest from there. Now, what's really interesting is we're taking these bubbles, these color combos, and then we're showing it on kind of this fluid graphic that goes back to 2022 and shows what the layoffs have been like from 2022 until 2023. So the end of 2022, last quarter of 2022, first quarter of 2023. Now, just for ease of visualization of this, keep in mind that pink is technology and green is consumer discretionary. These colors all relate over to the fluid graphic on the right. So for example, here's the green, here's the pink. You can see the large amount of layoffs. In fact, right here was IKEA dropping off a bunch of jobs and so on. Here's Facebook in the pink taking a lot of jobs out of their business and so on. And so you can see kind of the green and the pink flow. And then look what happened right here in the middle of January. We see this huge chunk of layoffs taking place on both sides. Here's Microsoft and Alphabet. Over here is Amazon, and obviously there were a lot of others included. They weren't the only ones in there, but you can see the great big chunk of pink, I'll say orange, and green in there. But more importantly than that, look at kind of the width of it all. So, there's a lot of layoffs taking place here. This is definitely wider than it would have been quarters before that. But compare the fourth quarter of last year to the first quarter of this year, and you can see how the width really spreads out. So we're starting to see these layoffs kind of really grab traction in the negative way from the traditional view of it. But I will say from a Federal Reserve perspective, it is kind of a positive thing, because keep in mind from previous discussions, we know that the Federal Reserve is cranking up interest rates, trying to slow down hiring. They want to see unemployment start to rise because that will taper off, at least predicted that will taper off the inflation rate. So these things have been happening. Now the question is, with unemployment starting to go back up, what might that say towards a recession and ultimately the creation of a recession by the Federal Reserve cranking up interest rates, which they've said that we can anticipate a recession, but they are hoping it'll be a relatively soft landing on that recession. What does that mean? So here we are in the next graphic, and we're looking at the surprising link between unemployment and recessions. And as it says, economic data shows that recessions are often preceded by a cyclical low in unemployment. And right now, we've got ourselves a cyclical low in unemployment at a 53-year low over here on the far right, 53-year low at 3.4%, and it's now starting to edge its way back up. So the question is, what's happened in the past, when we've hit these lows? So here we hit a low, and then it's followed by a big jump up with a recession. Here we hit a low, recession. Here we hit another kind of mini low with a recession. Here we hit a low, recession. Here we hit a low, recession. Here's prior to the financial crisis in '08, and then we hit this recession coming back up. And now we've got all of this unemployment that's come down prior to the pandemic. We get this huge spike up, and there's another recession in there. And now it's all been coming down again. And the Federal Reserve is really trying to increase it. And in theory, that could lead to the next recession. Now, the fly in the ointment on a graphic like this is you never really know where the bottom is, right? So here, when we're coming down, was the bottom going to be here? Was the bottom going to be here? Was the bottom going to be here? Turns out the bottom was here. You never really know where the bottom is going to be. And then with the pandemic, one could argue that wasn't really economic related. That was a very odd kind of act of God or man that infused itself unexpectedly into the economy to create this huge spike up, and now we've been coming down again. So the question then becomes, where truly is the bottom? Have we hit the bottom? The Federal Reserve seems to think that we have. Many economists seem to think that we have. The question now becomes, will a recession follow? And obviously, all of these things have an impact on the stock market. So let's take a look at that next. All right, here we are with capitalization. As we mentioned last time we spoke, on the shortest viewpoint, the nano view of everything, we were starting to see this red, and we didn't know if it was going to pick up momentum and spill over into the longer term views of micro, meso, and macro, and it has. So we've got almost a diagonal line taking place here of red, which means a bearish view of what's been going on in capitalization. And you can see it's the mid caps and the small caps that are really kind of pulling down on the market. Right now, it's the large caps that are buoying it up a bit. And we're seeing, however, that the overall market has just turned below the zero line. So we are getting a bearish tip to the overall market right now, although the longer term is still hanging on to its bullish feel. The short term is outweighing it here, which is what we're really seeing down here on the bottom. We've got this overall trending that was taking place here of red. Then we were getting green. Now we're getting red again. And if we look at it from a capitalization standpoint, we see something pretty similar. We've got a diagonal taking place here kind of again, with the bearish being at the bottom and the bullish being towards the top. The overall sector is just below zero, the weighting of all those. And then interestingly, remember on our graphic about layoffs, we saw information or technology leading the way on layoffs, followed by consumer discretionary. And now these are two of the top three that are buoying the market back up. So what that's telling you is that Wall Street believes that those layoffs were a good thing for the company to eliminate those expenses, prepare for a potential recession, and they've kind of rewarded that, if you will, in terms of a stock price. So kind of interesting how all of this fits together. And then we take a look at the bonds. And here in the bond arena, whoops, we jumped too far. Here in the bond arena, we're seeing the opposite happen. As the equities have started turning towards a bearish tilt, the bonds are turning towards a green or a bullish tilt. The overall bond market is coming in with solid greens across the board. The only thing that's looking bearish at all right now is high yield corporates down here at the bottom. We've got long-term treasuries up here at the top. We've got corporate bonds in the center, and we've got midterm treasuries following up after that. And then we've got the really short-term stuff and the high-yield stuff down here at the very bottom. So we're starting to see kind of that flight to safety taking place with the bullish tilt of the bond market. And then finally, internationals. With internationals, we are seeing the bearish trend here on the shortest terms of micro and nano, but we're still hanging with a fair amount of green over here on macro and meso. Overall, the international market is a little bit above the zero line, but it too has both reds on macro and micro, nano and micro, and both greens on macro and meso. So it's kind of right at that teetering point in the middle. Likely the way of the U.S. market will become the way of the international market, I would assume at this point in time. But again, it really kind of depends on where this is going with interest rates. Have we kind of hit our peak on inflation? Are we seeing unemployment start to increase? Is that going to put us into a recession, or is that not? There's too many variables to make any kind of a true prediction. But what we can do is identify the trends, which is what we just did for you here today. Hope you've enjoyed this. We'll be back again soon.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.